Hey everyone, and welcome to This Explainer. Today, we are tackling something that, let's be honest, often feels like a massive, complicated puzzle. We're looking at the Finance Act 2024 rules for UK corporation tax. Now, whether you are gearing up for your 2025 exams or you're just trying to wrap your head around corporate year-end processes, don't worry. We're going to break this incredibly dense chapter down into a really logical, step-by-step journey. Okay, let's dive right in. Before we even think about calculating a single number, we really have to ask a fundamental question. What exactly makes a company a UK tax resident? It's the absolute critical first step, right? Because if a company actually falls into this net, well, it changes absolutely everything about how they have to report to the government. So the scope basically boils down to two main criteria. A company is considered a UK resident if, 1, it's incorporated in the UK, or 2, its central management and control are exercised there. You hit either of those, and the company is getting taxed on its worldwide income and gains. But, there's a crucial little trap here you need to avoid regarding timeframes. An accounting period literally cannot exceed 12 months. So if a company's period of account runs long, let's say it's 15 months, you can't just do one giant calculation for the whole thing. You're strictly required to split it up into two separate tax computations.
Here's our roadmap for the calculation today. We'll start with scope and computation, move on to cracking the tax rates, explore capital allowances and R&D, navigate trading losses, and finally wrap it all up with loans and deficits.
All right, let's kick things off right away with Section 1, Scope and the Computation. I want you to think of the corporate tax calculation like a giant funnel. Up at the very top, we pour in all those different streams of worldwide income. We're talking trading, property, non-trading loans, and chargeable gains. That all pulls together to give us our total profits. But hold on. We don't actually pay tax on that number just yet. First, we filter out our qualifying charitable donations, and that finally leaves us with our taxable total profits, or TTP. Now, there is one final step at the bottom of this funnel. We add back exempt dividends to reach a completely different number called augmented profits. Why go through that extra step? Well, augmented profits are strictly used to figure out exactly which tax bracket you belong in, and that leads us perfectly into Section 2, cracking the tax rates. This is where we figure out how much of that profit actually goes to the government. And we have a massive jump here. If your augmented profits are £50,000 or less, you are sitting pretty at the 19% small profits rate. But if you hit £250,000, you're bumped all the way up to the 25% main rate. But here is the real kicker. The real hidden trap lies in that middle ground, what we call the marginal relief zone, where the effective marginal rate is actually a whopping 26.5%. Now, because augmented profits literally dictate your tax rate, we need to be crystal clear on what they actually are. It's your taxable total profits plus those exempt dividends we mentioned. But watch out, because there's a classic trap here. You must exclude dividends from 51% group and consortium companies. Seriously, do not add those in. And remember, the vast majority of dividend income is totally exempt from corporation tax anyway. We are only adding them back here strictly for rate banding purposes, just to see if your company gets shoved into that higher 25% or 26.5% bracket. So this brings us to the marginal relief formula. I know it looks a little intimidating at first glance, but we can easily break it down into 3 sequential steps. Step 1, take the upper limit, which is generally £250,000, and subtract your augmented profits. Step 2, multiply that result by your taxable total profits over your augmented profits. And step 3, multiply all of that by the 3/200 marginal fraction. Now keep in mind, those upper and lower limits aren't always static. They are actually reduced pro rata if your accounting period happens to be less than 12 months, and they're also divided by the number of associated companies you have worldwide. £20 million. Now that is a massive threshold. If your taxable total profits blow past this number, you are officially classified as a very large company, and trust me, it changes how you pay your tax. Instead of paying later on, very large companies must start paying quarterly installments on the 14th of month 3 of their accounting period. Just to put that into perspective for a second, regular large companies, so those over £1.5 million, they don't even start paying their quarterly installments until month 7. Let's shift gears to Section 3, capital allowances and R&D. This is arguably the most rewarding part of the whole journey, because this is exactly how companies legally slash their tax bills, through allowances and innovation. £1 million. This right here is the cap for the annual investment allowance, or AIA. Honestly, it's a tax accountant's best friend. It allows companies to deduct 100% of the costs of qualifying plant and machinery right off their profits. The really beautiful thing about the AIA is that there is absolutely no time limit on the scheme itself. However, the expenditure has to be incurred in the first year for you to claim it. But the AIA isn't your only tool in the toolbox. You basically have two main options when it comes to new assets. On one hand, you have full expensing, which gives you a 100% first-year allowance on new main pool plant and machinery, though keep in mind that's strictly for companies. Contrast that with the special rate first-year allowance. That gives you 50% on new special rate pool assets, things like long-life assets or integral features. So the crucial takeaway here is that you have options. However, you must firmly remember, full expensing and the AIA cannot both be claimed on the exact same piece of expenditure. You really have to map out and choose your strategy. Moving on from physical assets to pure innovation, let's look at the new research and development rules that kicked in from April 2024. We now have the standard merged RDC scheme, which gives all companies a straight 20% credit on qualifying R&D revenue expenditure. But compare that to the IRIS scheme. IRIS is incredibly lucrative. It offers a massive 186% total deduction and a 14.5% tax credit. However, it's designed specifically as a safety net. It's strictly for loss-making SMEs and only where their R&D actually makes up at least 30% of their total expenses. Speaking of loss-making companies, that brings us perfectly to Section 4, Navigating Trading Losses. So what exactly must a company do when the math goes negative and they generate a trading loss? Let's rapid fire through your chronological options here. First, you have Section 37, where you set the loss against your total profits of the current period. Second, if you still have losses left over, you can carry them back 1 year against the prior period's total profits, but, and this is a big but, you must claim current year relief first. Third option, you can carry the loss forward under Section 45A against future profits. And I really want to emphasize this point. Carried forward losses can now go against your future total profits, not just your future trading income. That's a huge deal. Finally, if the trade is actually shutting down completely, you have terminal loss relief, which allows you to carry back losses from the final 12 months up to 3 years. But of course, there is a catch when carrying losses forward, and it's called the deductions allowance. This is essentially a group-wide restriction ceiling, and it's set at £5 million plus 50% of your remaining profits. Basically, the government says you cannot wipe out massive future profits entirely with old losses. However, the silver lining here is that a company can strategically choose exactly how they want to allocate this £5 million allowance across their different profit streams to truly optimize their overall tax position. All right, we are now entering the final stretch of our computation journey today. Section 5, Loans and Other Deficits. Let's contrast exactly how the tax code treats different types of loans. Take trading loan relationships. Think of something like a standard bank overdraft you use to run your day-to-day trade. The credits and debits for this go straight into your trading income. Really simple, right? On the flip side, we have non-trading loan relationships, or NTLRs. These are things like intercompany loans or investments. If an NTLR creates a deficit, you have options. You can set it against your current total profits, carry it back 1 year, or just carry it forward. Now, a very, very important warning here. If you are dealing with connected company loans, you absolutely must use the amortized cost basis, and any write-offs between connected parties are generally entirely disallowed for tax purposes. No exceptions. To lock this all in, our source material breaks down these other secondary losses into a really strict set of rules. Think of this as your ultimate cheat sheet. Capital losses, they can only go against current chargeable gains or be carried forward against future gains. That's it. Nothing else. Property losses, well, they can be set against current and future total profits, but you absolutely cannot carry them back. And NTLR deficits, like we literally just discussed, they have the most flexibility. Current total profits, back 1 year against NTLR income, or forward. Isolating these rules side by side like this is the best way to make them stick perfectly in your memory. Which brings us to the end of our explainer. We've built the computation from the ground up, we've cracked the rates, leveraged those sweet allowances, and successfully navigated the losses. So I want to leave you with this final, somewhat provocative thought. As tax laws continuously evolve, how will your company strategically structure its next computation to maximize these reliefs? Because whether you are applying this exact framework to real-world financial strategies tomorrow, or you're just sitting down for your 2025 exams, mastering these sequential steps is your absolute key to conquering UK corporation tax. Thank you so much for learning with me today.